All right, let's get straight into it. What we're going to cover today is a structured way to approach trading. Now, let's be crystal clear. This isn't some magic shortcut. It's not a get-rich-quick system. What it is a rule-based framework. The entire point here is to build consistency by taking your own subjective, emotional decisions out of the equation. So, which one is it for you? Are you chasing those big, exciting breakouts? Or are you trying to be a hero and predict the exact top of a move? Look, if your results feel random, it's probably because you're bouncing between these two conflicting behaviors. One minute, you're chasing hype. The next, you're trying to predict a reversal. Both of these are driven purely by emotion, not logic. You know, these two mistakes, they're the main reason why so many trading accounts look like a random number generator. Think about it. When you chase a breakout, you're buying right at the peak of excitement, which is also the peak of risk. On the flip side, trying to catch a falling knife and predict a reversal, you're literally fighting an established trend. That is a low probability game, plain and simple. Both of these are just guessing games. They're about prediction. What we're going to focus on is something completely different. It's about participation. So, here's the alternative. The only logical thing to do is to just step off that emotional roller coaster. We need a complete mental shift away from trying to predict the future and towards simply participating in what the market is already doing. It's not about what you think will happen next. It's about reacting to what's happening right now. Okay, so this strategy we're building, it does neither of those things. In fact, it strictly forbids them. We don't chase and we don't predict. The logic is incredibly simple. We only get involved after a trend has already shown its hand. Once it's established, that's it. This one rule alone completely removes the guesswork from your process. So what do we call this? The official term is pullback to structure in an uptrend. It's what's known as a trend continuation strategy. And listen, the goal here isn't to be a hero and buy the absolute bottom or sell the absolute top. Forget that. The goal is to have a system, a repeatable process to join a trend that's already moving. Yeah, this quote really gets to the heart of it. Strong trends do not move in a straight line. They just don't. Think of it like breathing. A healthy trend moves up, takes a breath, that's the pause, and then continues on its way. These pauses, these pullbacks, they aren't a sign of weakness. They are a feature of a healthy, strong trend. And for us, that's where the opportunity is, right there in the pause. All right, let's talk about execution. This next part is absolutely critical. We're going to lay out the execution protocol. And let me be clear, these are not friendly suggestions or loose guidelines. These are hard, non-negotiable rules. Think of it like a pilot's pre-flight checklist. If even one single item isn't checked off, the trade does not happen, period. Okay, so here's the 4-step process. It's a sequence, and the order is mandatory. You have to do them in this order. Step 1, confirm the trend alignment. Step 2, wait for a valid pullback. Step 3, define your risk first. And finally, step 4, predefine your target. Simple, sequential, and not to be broken. Let's break down rule number 1. Trend alignment is the first gate you have to pass through. You need a clear, confirmed uptrend. If the chart is messy, sideways, or just confusing, if you have to squint to see the trend, then there's no trade. It's that simple. The default action in trading is to do nothing. So if the trend isn't obvious, we stay out. All right, rule number 2. This one goes against every emotional urge you might have. We do not buy strength. Let me repeat that. We are not chasing green candles. The rule, the protocol, requires us to be patient and wait for the price to come back to us, to pull back into a known area of support. Why? Because this gives us a much better price. It reduces our risk, and it completely short-circuits that emotional, FOMO-driven decision-making. Okay, on to rule number 3, and this is a big one. Risk is defined before you even think about hitting the buy button. You need to know your stop loss. That's the exact price where your trade idea is proven wrong. You set that first. And if the distance to that stop loss is too big, if the risk is more than your plan allows, you walk away. The trade is rejected. We don't even think about how much we could make until we know exactly how much we stand to lose. And that brings us to our final rule, rule number 4. Once you've defined your risk, now you can look at the potential reward. You establish a logical target for the trade, and the question is simple. Is the potential reward big enough to justify the risk you're about to take? If the answer is no, if you're risking $1 to make 50 cents, you skip the trade. We are only interested in taking trades that have a positive mathematical edge. So when you put all these rules together, you get a very specific philosophy. Let's be honest. The goal here is not to have an exciting time. It's not about being in the market all day. The single solitary objective is long-term consistency. And the only way to get there is with a process that is mechanical, rule-based, and, well, kind of boring. So what does this actually look like in practice? Well, here are the characteristics. First off, it's boring by design, and that's a good thing. It means you're not making emotional decisions. Second, you're going to get fewer trades because you're waiting for the perfect setup. This approach naturally avoids all the market noise and chop. It completely gets rid of the need to predict anything. And most importantly, its number one job is to protect your capital. You know, this kind of framework is actually built for people who have a life outside of trading. Because you're waiting for very specific conditions to line up, you don't have to be glued to your screen all day. It's perfect for someone with a full-time job or other commitments who needs a clear, rule-based process they can manage without it taking over everything. Really, you could boil this entire philosophy down to one single directive, one strategy, one setup: clear rules. Anything, and I mean anything, that falls outside of that framework is just noise. It's something you observe, not something you act on. This is how you stop gambling. This is how you systematically remove the random variables from your performance. So at the end of the day, a framework like this really forces you to ask yourself a very important question. What is your goal here? Is it excitement? Is it the thrill of predicting and being in the action all the time? Or is your goal consistency, something that can only come from a mechanical, rule-based process? Your answer to that question will define everything about how you approach the markets.